This is Rich Nelson with Allendale. Thanks for listening to our Cattle on Feed preview. This Cattle on Feed report will be coming out this Friday, June 17th here at 2 p.m. here. And key issue we're going to talk about this one is dwindling numbers coming to town as far as our little preview. Some of the messages that we're talking about here where this report should show a change now in the placement pace, and this should be showing some numbers here for the long term that will be showing some supply deficits coming up in the future. Now, of course, the picture we have here is a pasture with a wide expanse, but only three animals on this pasture here. So, bottom line right now with this whole picture is we are going to see some of the benefits now from the liquidation we've had here going on since 2006 here. In terms of the key report or the key section of the report we all look at here at first glance, this is of course going to be placements here. As you can tell by this chart here, the yellow bars from last year during fall, for instance from August all the way through December, we all saw higher placements than last year running through fall and winter, and of course that trend generally held up from January through April as well, as shown by the red dots, which are higher than last year. So bottom line as far as placements, we had active placements in the fall and winter, and this will of course mean higher numbers of slaughter-ready cattle this summer. And of course we actually are now starting to see some of those numbers still continue to show up here. We will show a bulge here during the summer. As you can tell back in December, that yellow bar was actually a full 17% higher than last year number. And of course, those are being processed right now. That will continue through August here for those December placements. So bottom line here is we are going to see continued high slaughter levels through the summer because of that high placement pace in previous months. Now for this report here, for the month of May, you'll notice this, actually two of the things we can point out here, both May and June last year, those yellow bars, those actually were significantly higher than the previous year levels. For May, that was actually a full 23% higher than May of 2009. Now, the red dot we just put on here shows, of course, Allendale's estimate. We look for a 7% drop in placements, and the trade agrees with us. The average trade guesstimate calls for a 7.5% decline here. So the bottom line is we are seeing lower placements now show up, not only because of the simple fact that last year was an extreme type of year during that May and June placement pace, but also we have some other issues here certainly supporting a lower placement pace now. And the first one is price. As you can tell by the green, these green dots, these are of course cash cattle prices here over this past year, and as you can tell during May, we pretty much had an extreme slide in prices through all of May. So number one issue you can point out is simple profitability concerns here. We really changed psychology in the cattle feeding industry sharply with this price decline in May, and therefore we saw less interest in feeding out cattle here. And that's also shown by this chart, which is cash feeder prices at Oklahoma City. From the start of May to the end of May, you had as much as about an $8 to $9 drop in feeder cattle prices here. So bottom line, first issue is certainly going to be profitability concerns here and a lack of interest in cattle feeding, which suddenly showed up during May. Second issue, which we have been talking about for some time, and much of the industry knows about these type of numbers here, is the simple fact we're probably running out of calves and available calves and feeders. So if you look at since September of last year, so in other words, since when those first of the 2010 calf crop calves would be available at the sale barn, since that point, all the way through this May period, we've placed about 4% more cattle than last year. And this may not make sense to a lot of people who say, well, we've placed 4% more cattle from that period, from September on, but wasn't the calf crop about 1% less? And that's exactly right here. In fact, to kind of make the numbers match out, you'd actually have to drop placement sharply during June, July, and August to make it all kind of match out. And that placement drop would have to be as much as 14% versus last year. So that shows the severity of how tight this calf crop could potentially be. And it also shows that, there's a good chance that a lot of these calves and feeders which were placed in the past few months were probably also intended heifer replacements. So not only have we used a lot of the calf crop itself from 2010, a lot more than we normally would at this time of year, but at the exact same time, we're also drawing down breeding herd supplies, most likely here. Now, the key issue with this placement numbers is we're starting a lower placement number here during May, and this is probably going to last with us here for some time. And of course, this is going to tighten up that supply period here for the longer-term issue, certainly starting in the fourth quarter of this year, but most likely really getting going in the first quarter 2012. Now, the other category, the second category that we watch in the report is called marketings. These are marketings of fat cattle moving from feedlots straight to the packing plant. And as you can tell by this red dot here for May, we do expect about a 3% increase in marketings compared to May of 2010. And the trade agrees with us. The average trade guess, I believe, is about a 3.2% increase here for marketings. So for this summer period, I talked previously about expecting this bulge in supplies here showing up in summer. And as you can tell by this chart, we're now just starting to see it here. So not only do you see that June is typically the highest month of marketings of feedlot-style cattle, but on top of that, we're going to see that bulge from those placements back in fall and winter. So we should see high slaughter levels during summer, keeping cash cattle prices limited here before we see a sharp rebound in prices coming towards the end of this year. Another measurement that some people put together here is estimating the number of cattle and feed that have been in those feedlots for over 4 months. In other words, how many of those market ready, or how much of the herd itself that's in the feedlot is market ready. And as you can tell by this blue bar, we calculate cattle and feed for over 120 days. This will actually be about 11% over last year. So this shows the very front-weighted nature of this current slaughter schedule we expect. So you are going to see heavy numbers during June, July, and August before tailing off sharply for September and October here. But the main result, or the main point we're looking at for this cattle and feed report, yes, it is going to show heavy numbers up front, heavy slaughter levels this summer, which have yet to really be felt or priced in here just yet. But more important for us is this is going to be the start of our change in placement pace we've been expecting here for several months. We should see cash cattle prices we still expect down to 101 here for the summer low, but we will see a dramatic rise in prices really starting here after summer and really getting going as we get into the fourth quarter of this year and the first quarter of next year. So in other words, this should be the beginning of the change in placements and change in supply levels, hopefully, which will be felt going into 2012. If you have any questions about this report or how it affects your operation or any recommendations we have with this, please feel free to give us a call here at Allendale, 1-800-262-7538. Thank you.